Here are your top 3 Canadian real estate stories for July 2025. Ontario homeowners may be dodging insolvency for now, but cracks in the financial system are showing. Asking rents in this Canadian city have gone up by 71%. We'll tell you about what's happening in that specific city. And finally, Canada's economy has hit the brakes in April. And while that's bad news for growth, it might be good news for mortgage holders. All right, for our first story, let's head east. Insolvency filings fall in Ontario, but signs of homeowner strain persist. Ontario insolvencies dipped in April, but the data suggests homeowners are hanging on and not bouncing back. Ontario saw a 5.3% drop in consumer insolvency filings in April compared to the same time last year, according to new data from the Office of Superintendent of Bankruptcy. While that may appear positive on the surface, some experts warn it's not necessarily a sign of recovery. Recent data from insolvency firm Hoyes Mikolos suggests that Ontario households are still under significant financial stress, particularly those with mortgages. Reading on, mortgage holders under strain. That same firm indicates that the bankruptcy index rose by 8.5% in May, a 3.2% year-over-year increase, and one of its highest readings in recent years. The index tracks the share of insolvent debtors who own a home, and the latest uptick highlights growing pressure on borrowers juggling high interest debt alongside their mortgage. According to the firm, the average insolvent homeowner currently owes an additional $72,510 in unsecured debt on top of their mortgage debt. For many, it's not the mortgage itself that triggers insolvency, rather the compounding effect of credit card balances, personal loans, and other unsecured borrowing layered on top of housing. Those most vulnerable to insolvency include landlords with multiple properties who are struggling to manage their mortgage payments, as well as pre-construction buyers facing challenges closing as planned. Falling property values, rising interest rates, and construction delays are all contributing factors. Just to quickly take a brief pause here, I get lots of folks who reach out from Ontario who are looking for potential ways of restructuring their debt. But what we've seen in Ontario is a falling home price. Now, a lot of people count on that appreciation to hold them through. But if home prices are falling, you lose a lot of your flexibility when it comes to things like managing debt. If you're constantly able to kind of package the debt, consolidate it, and get a lower payment, you can survive, but that only works if your home value continues to go up. If the home value falls, you run into trouble, which is what I think partly what we're seeing here in Ontario. And I love this chart here because I do think it kind of illustrates what's happening. This is for consumer insolvencies, and you can see the Canadian graph versus Ontario. And we look at May 2020, we hit an all-time low. Very few people claiming that consumer insolvency, and we've just seen that steadily rise over the last 5 years. Now, this specific story talks about one particular Canadian city, but I think this stat could be an indicator for a lot of Canadian cities where we've seen rent jump a lot. Let's get into it here. Asking rents up nearly 71% in 6 years in this Canadian city. A new Stats Canada report says asking rent in Montreal has risen nearly by 71% since 2019. Average asking rent for a 2-bedroom apartment was $1,930 in the first quarter of 2025, up from $1,130 6 years ago. Asking rents have roughly doubled in some other Quebec cities, including Drummondville and Sherbrooke. Montreal ranks 17th for the average asking rent among Canadian cities in 2025, well behind Vancouver at $3,170 and Toronto at $2,690. Asking rents has increased by just 27% in Vancouver over the last 6 years and only 5% in Toronto. The report notes that asking rents tend to be higher than rents paid by long-term tenants and offer a picture of current market trends. Rents have been really crazy, even in our local market of Saskatoon. I'm based in Saskatchewan. I've seen that steadily. This would be very indicative of what we've seen take place across the country, and especially in markets that didn't see those big jumps. like kind of the secondary markets of, Edmonton, Calgary, Saskatoon. And so I think this is just something that is, if you're a person who doesn't own a property, and some people will give you advice that it's better to rent than to buy. Well, here's a story that kind of indicates why it is important to buy a property, because sometimes your rent does not just strictly increase by that 2% inflation number. Sometimes we see a large, drastic increase at once. And so this makes it tough for people on fixed income. So feel bad for folks who have to rent. If you can, obviously get into the market if it makes financial sense for you. All right, and finally, our story for the mortgage holders. Canada's economy stalls in April, giving Bank of Canada more room to ease. Canada's economy dipped 0.1% in April, coming in below expectation and adding speculation that the Bank of Canada may have more room to cut rates this summer. Stats Canada advanced estimate for May suggests a second consecutive month decline of 0.1%, pointing to a stalled second quarter for growth. Most economists now expect a mild contraction in Q2 GDP, particularly as output in tariff-sensitive sectors like manufacturing and wholesale trade continues to decline in response to weaker demand. Moving on to the implications for the Bank of Canada. While real GDP now tracking anywhere from 0.03% to 0.05% contraction in Q2, the data lands between the Bank of Canada's April MPR scenarios of 0% for baseline and down 1.3% on the downside case. While that certainty is not good news, wrote BMO's Porter, he added that it's also a less dire outcome than expected several months back. Economists are largely in agreement that softening growth backdrop gives the central bank room to cut again. We think the Bank of Canada has headroom to cut the policy rate 2 more times this year, Eric Howlow said, though more evidence on inflation and jobs is needed ahead of the next rate decision in July. Market pricing has modest increased odds of a July cut following the GDP miss, while bond yields have edged slower. So quickly focusing on that last sentence, especially if you're someone who has a variable mortgage, a home equity line of credit, or you have an upcoming renewal and you're wanting to take a fixed rate. If the Bank of Canada cuts at the end of July, that means a direct impact on your variable rate mortgage where you're going to, get that savings on that. So good news for anyone who is an existing variable rate mortgage holder or wanting to opt for the variable rate mortgage. And then importantly, what we're really focused on with fixed rates right now is we haven't seen the decline that a lot of people were hoping for. And that's because the bond market has been particularly strong. And so in this last sentence, bond yields have edged lower. This is good news. If bond yields continue to come down, this is what all Canadian lenders base their fixed rates on. And so if we see a reduction in bond yields, you can expect lower fixed rate mortgages on your upcoming renewal. If you have any questions in regards to variable versus fixed or an upcoming renewal, please reach out. I'd be happy to assist. I'm licensed as a mortgage broker in both Alberta and Saskatchewan and can assist to make sure you have the best rate and are getting treated the best by your lender. If you enjoyed this video, you're going to like this one.